Hi, and welcome to Rocket Fuel, your daily update of everything that's happening in the Rocket Pool community. My name is Wack. Today is February 23rd, and today's episode is going to cover Val's new cohesive vision for the new tokenomics. We're going to cover a whole lot of controversy around an ETH research proposal to change the yield for staking rewards, and we're also going to cover a fee switch for RPL and what that might look like. So let's get into the episode now.
10, 9, ignition sequence start, 6.
So let's get started here with this tweet that RocketScan put out, and this was letting people know that Val's valuable proposal has just dropped, and this is Val's updated cohesive vision for what he thinks the Rocket Pool's tokenomics should be like going into Saturn. And here RocketScan says, there'll be ETH only mini pools. The first two mini pools will have 4 ETH collateral, and after that there'll be 1.5 ETH collateral, and RPL will earn Ethereum rewards without running mini pools. So let's have a look and see what this is. So Val starts his paper, his document, his vision with a table of contents, and the first thing that he wants is the motivation. So let's talk about the motivation. He says, let's start with the desired end state. So the first goal here is that being an ETH node operator with Rocket Pool will be comparable versus competitors such as Lido, and starting at some minimum level of bonded ETH. And then it depends on what the node operator commission is and what borrowed ETH per bonded ETH is as well. And he says we're trying to attract enough R ETH holders to get us to our desired market share, and we're trying to capture all surplus value in RPL as well. So those are some of the points that Val has started with. Then he goes on to the core concept, right? So the main thing here is having better bonding curve. This is we'll start by determining a good node operator commission percentage using the aggressive alt bond I described. The summary of the idea is that we can allow smaller ETH bonds safely to enabling MEV theft penalties across a whole node. Smaller ETH bonds make us dramatically more capital efficient. So he says, remember for context that the proposed Lido CSM return on investment is 1.5 times solo staker rewards. Here he says is capital efficiency for Rocket Pool, where we are charging the ETH that will go to node operators. So how is it going to work? So here there's a 3 splits, like with 3%, 4%, and 5%. There's some graphs here basically showing that at 3%, your commission will max out at around 1.6 times solo staking if you have infinite ETH staked, but approaching 1.6. With 4%, you'll have approaching 1.8, and 5% you'll be approaching 2 times solo staking. So Val goes on to say we said that 5% commission competes favorably with Lido CSM starting at 11 ETH bonded, and that's two 4 ETH mini pools and 2 1.5 ETH mini pools. He says that high bonds we do significantly better. Even 3% was able to beat Lido CSM, and that was at 30.5 ETH. He says that said, I explicitly would like to err on the side of growth. I propose using 5%, which would then max out your staking rewards at basically double solo staking if you have a whole lot of ETH staked, or approaching double, which is really exciting. Okay, then he goes on to explain how RPL's value capture will take place. So he says that the RETH commission is going to be much higher per bonded ETH with those lower bonds. So node operators can be more competitive as shown above. It says the surplus revenue can then be directed to RPL holders. So it's pro rata based on RPL stake. So here he's got a couple of diagrams that show that basically right now 86% of ETH staking rewards go to RETH holders, and then you also get 14% of the rewards go to the commission as to node operators. However, what Val is saying here is under the new proposal that he's suggesting 86% will still go to RETH holders. However, 5% will go to node operators and 9% will go to Rocket Pool stakers, RPL stakers. So here he's explaining the flow diagram of what that looks like. So if there's 100 ETH of revenue coming in, he shows 3 users, right, who are staking they're getting revenue that's coming in. So the first staker will have 4 ETH staked and 0 RPL. The second staker will have 4 ETH staked and 100 RPL, and the third person will have 0 ETH and 100 RPL. So if that staking pool generates 100 ETH of revenue, 86 ETH will go to the RETH holders. However, if you are just an ETH staker, you'll be getting 2.5 ETH of rewards, or 2.5 units of rewards. If you are ETH and RPL staker, you'll be getting 7 units of rewards. And if you are an RPL only staker, you'll be getting 4.5 units of rewards. Now, that is, it makes it look really good, right? For RPL holders, it gives it a really nice value proposition. Although this example here is even more like explicit in how that works. So he says, now let's illustrate one more thing. Here we've grown our revenue by 10 times by onboarding a bunch of ETH only stakers. So he says there are 21 users now. So we have 19 users who have 4 ETH and 0 RPL, and then 1 user who has 4 ETH and 100 RPL, and 1 user who has 0 ETH and 100 RPL. And now, because we've grown 10 times, the revenue is 1,000. So 860 revenue still goes to the RETH holders, and each ETH staker will be getting 2.5 units of rewards. However, the people who stake ETH and RPL will be getting 47.5 units of rewards, and the people who stake only RPL will be getting 45 units of rewards. So this just shows you that, like, if there's this common example, right? Like, why would anyone want to use RPL? They'll just stake with ETH. Well, that is wonderful, right? Because there are people out there like me who will want to stake with RPL, and the more ETH only node operators there are, the more rewards I will be getting. So I think that will bring on a lot of demand for RPL. So then, Val goes on and shares about how that works. And then the next section of the cohesive vision is like this required support. So he says that there's a couple of other things that will have to go, come together for this to work out properly. And one of those is universal variable income. It says this portion going to node operators and RPL stakers should be settled by vote. Our ETH's portion is simply 100 minus these two portions. So it basically says that depending on what the conditions are like in staking, the RETH holders will get more or less commission. Sorry, they'll pay more or less commission. So if we need more RETH to come online, then we'll get RETH holders to pay less commission, which makes RETH a better, more attractive product. But if we're struggling to get node operators online, then we can increase the commission for RETH holders, and that will entice node operators to come online because they'll get even more outsized rewards. Next, we have mega pools. So this is actually like a really amazing development, because as you get those really small 1.5 ETH validators online, the cost of gas to get that online becomes significant as a percentage of your investment. So having mega pools will actually radically decrease the gas costs of spinning up a validator, which will then make it easy, like much more profitable to use this sublinear bonding. And then forced exits as well, which this will be critical to protect against loss scenarios associated with MEV theft and abandonment. And then there's an example of what that will look like. And then Val says, then you can go into further depths, right, of like really analyzing all this information. And there's tier 1, tier 2, tier 3. But he says only go into those, and like dig into those if you kind of understand what's happening in the main document here. So I'm not going to cover those. I'm going to leave that for you all to read, or to read about in mine and Jasper's newsletter that is starting hopefully next week. So that's really exciting. Okay, next we've got something that's really controversial. Actually, one of the most controversial things I've heard come out of the Ethereum research space recently, and this is Casper here wrote a paper called Endgame Staking Economics: A Case for Targeting. So he says this post explores the status quo of staking economics, its drawbacks as we see them, and what the end game of staking economics could look like. Read about a separate proposal for an immediate insurance policy update in the lecture here. So then there's like TLDR. Let's just have a look at the TLDR and have a quick look at the article. So he says, today 30 million or 1/4 of all ETH is staked, and with the trend of increasing staking showing no signs of stopping, we argue that most of the new stake will be driven by LSTs, and I guess LRTs as well, which gain in moneyness with adoption and time. And a world in which most ETH is staked through LSTs has several implications that we consider negative. LSTs have winner takes most dynamics due to network effects of liquidity, economies of scale, increased competitive pressures for solo staking viability. Further, LST replacing ETH as the de facto money of the network, apart from layer 1 transaction fees, leads to Ethereum users being exposed to counterparty risk inherited by the LST by default. For true economic scalability, the money of Ethereum should be maximally trustless. Today, the issuance yield does not ensure a limit around the amount that can be staked profitably. LSTs have significantly changed the cost structuring of staking, making it possible that most ETH will be staked eventually. We argue that endgame staking economics should include an issuance policy that targets a range of staking ratios instead, around a quarter of all ETH. The intention is to be secure enough but avoid overpaying for security and thereby enabling said negative externalities. Says finally, we highlight some open research questions that need answering to make targeting policy feasible. So this was an extremely controversial article that came out today with people arguing for and against, and like the lines were drawn in strange ways. So we're going to talk about that in a minute. But so much so that, this morning on today's episode of the Daily Gwei, Anthony Sassano said that he would veto this. And what he meant to say was that this is something that in this current form and targeting the Petra release, it's something that he would actively argue against, thinking that we would need a lot more time and a lot more understanding of what the impact of this will have on Ethereum's monetary policy, and this change would be too big a change to rush in 7 months or whatever it will take before Petra is out. So you can see here that they're saying the stake is up only and to the right, and basically there's the staking reward, and then you add MEV on top, and that gives you kind of like an extra reward. So they're kind of talking about the issuance yield and how all that's looking. And then they talk about supply side issues and how you can kind of change those rewards to have different kind of users coming online. And the idea is that basically you would want solo stakers to stake on the network and disincentivize liquid staking tokens from gaining more of a market share. And of course, it's really hard to identify solo stakers, right? Because of Sybil resistance issues, you can't tell who is a solo. Node operators can hide, and make it look like they're solo validators when they might not be solo validators at all. They might be, single entities. So these are the kind of things that, this paper is kind of looking to address. And the moneyness, of course, this is something that Jasper, has talked about in his research papers about making our ETH the money of Ethereum, right? And because, he wants it to grow and be a really good money. Well, these guys are saying that, the Ethereum core researchers are saying that maybe it's the case that ETH should be the money and not an LST like our ETH. So you can go read the whole argument and the whole paper. It's quite long, so I'm not going to read it all. But basically, they even introduced this idea of negative issuance and how that might look, and basically other things like that. So yeah, this is, like I said, this is quite controversial. So let me actually go and show you this tweet thread. This is the tweet thread that Casper kind of wrote about in publishing the ideas. He says, wrote down some thoughts, exploring the status quo of staking economics, its drawbacks as we see them, and then what the end game of staking economics could look like, and what we should do in the short term until the end game. So he says, then kind of just goes over some of the points that we already covered and shows some of the graphs and kind of explains the graphs as well. So like I said, you can dig into these ideas more there. But the thing that I want to talk about is here, Jasper wrote a response saying, great writing, a few questions. He says, I've seen this 1/4 mark thrown around a few times, but is there any technical reasoning for that to be the ideal staking ratio? How do you know it's not 50% and that MEB makes it such that 67% isn't? It says also near the end, you write about how real yield is better than nominal yield. So still, solo stakers will still be attracted to stake versus the world where nominal yield is higher, but real yield is lower. Jasper says, I'm not sure this holds true in very many cases. Often nominal yield is more important to the end user. So nominal yield meaning that, you are getting some tokens, and real yield meaning how does that factor in with the value of the tokens overall. So for example, if you are getting 1% nominal yield, then on 100 ETH staked, you're getting 1 ETH of reward every year. But if ETH is deflating by 10% and you're getting 1 extra ETH, then your real yield is 11%, including the burn and the reward that you're getting. So Jasper was kind of like asking a question about that, saying nominal yield is often more important to the user. And then he says further, the idea of negative curves strongly favors centralization. At the margins, any amount of edge will force out solo stakers. For example, large enterprises willing to gamble on MEV payouts will take negative base rate if it becomes positive EV, expected value, from the rare lottery block. The lower the nominal rate becomes, the less attractive solo staking is, and the greater the threat of centralization from small differences. So the idea is here that, like, if there's a negative commission, and if you're losing 2% of your ETH every year that you're staking, but then staking company, like, I don't know, make one up, like Lidont, for example, if they're getting these MEV blocks that, even though their staking reward is like -2%, but they're making 3 or 4% because they're getting the majority of the lottery blocks, then for them it's still profitable to keep going. However, for home stakers, Jasper's arguing that for them it's not valuable anymore, right? They don't want to lose 2% of their ETH every year, for example. I'm just pulling numbers. So Casper here then replies saying those are great questions. Regarding the 1 quarter target, the specific target range is definitely an open question still. One useful way to think of this question can be considered the utility of different staking levels. The sketch from our post is just one example, of course. And then he says essentially there's a trade-off between costs of attacks and externalities of staking levels. There's no objectively optimal answer, but we can reason about it, though some thoughts by Vitalik and Justin on this. So here, Jack is a solo staker. He says, as a solo staker, I'm very concerned about lowering distribution. This seems like it would make staking less profitable for everyone, advantaging large operations and having increasing centralization effects. And Casper says, I would love to try to convince you otherwise. Currently 30 million ETH is staked, earning 3% issuance yield and 4% including MEV. Historically, the supply curve willing to stake has continually been pushed down, increasing short-term equilibrium level of staking as illustrated here. And then he goes on to say, but this won't be the end of it, because LSTs continue to benefit from network effects and economies of scale. This makes more people willing to scale via LSTs. In other words, the long-term equilibrium of staking is very much likely further out, 60 million, 80 million, maybe less, maybe more. And what he says, what I'm trying to say is that current staking yields won't be as high in the future, even if we change nothing. As a side note, current curve was chosen many months ago when LSTs restaking weren't a thing. Worry was more that not enough people would stake to get Beacon Chain launched. So he says, which long-term EQ should you prefer as a solo staker given 2 different issuance curves? Let's compare, and then he kind of gets into the details of what the current curve looks like and what the new issuance curve would look like and how that would all work out. And he says that Jack says, I'm willing to bet good money that the proportion of home stakers would be far higher with 100 million ETH staked than with 50 million ETH staked. Why wouldn't it? So that's a whole different discussion. But anyway, there's some more points that are coming up here. Here, Vasily, who is co-founder of Lido, he says there are 2 possible points of contention here. The low ETH, low percentage of ETH staked is preferable to high percentage of ETH staked in general, and the low percentage of ETH staked with the subpar validator set is preferable to a high percentage of ETH staked with an OK validator set. And then he says, I don't think either point is ironclad, to be honest. And then Jasper says, the day has finally come where me and Vasily agree. Many discussions need to be had about the ideal state of proof of stake, and we can't make decisions before that. There's also a belief that home stakers are more sensitive to real yields over nominal yields. I disagree. And then Nixo kind of like argued back against Jasper, saying that number 2, Vasily's point is a false dichotomy, and Jasper kind of explains why, you might be able to argue that it is, but he doesn't think it is. We also got a strong reaction from Eric Connor, who you might know from being an OG Ethereum, but also being on Anthony Cesano's show sometimes. And he says, nope, in my opinion, the Ethereum community should be done touching the issuance curve forever. Making it hardened is more important than trying to perfect it forever. Also, I fail to see how this won't just centralize stake more. And he says the TLDR is a weak issuance curve to target a percentage of total staked. After that point, issuance goes negative. Concern is large amount of ETH staked, mostly going to LSTs. But I just don't see how negative helps. LSTs can survive negative issuance longer than solo stakers. Finally, giving ETH issuance policy Lindy effect post proof of stake is extremely important to its perception as moneyness and investability. So this is a point that Eric Connor is kind of making, that too many Bitcoiners, for example, say, they dismiss ETH as money by saying that this is, it's like, we change the monetary policy on a whim and we can change it whenever we want. So it's not hard money. It's like soft money because of that. It's not as strong money as Bitcoin is. So Eric's kind of like arguing against that. But Nixo here replied as well, like, you're saying, are you okay with a scenario where 99% of ETH is staked and everybody who needs ETH has to use a derivative? Eric says there are inherent risks to staking. 0.01% yield doesn't mean everyone is eventually going to stake their ETH. Equilibrium is likely very close, in my humble opinion, somewhere around 2%. That is like a staking reward, and that's where people will stop staking. So Nixo says, respectfully, there's no evidence for that. It's entirely a guess on your part. There's abundant evidence that demand for stake is continuing at a fairly flat rate. You also didn't answer my question. So Eric says there's also no evidence that it will be all be staked. You're making the same type of assumption. The reality is no one knows where equilibrium is yet. This feels rushed. Also, if this is a huge concern, we should be pursuing enshrined LSTs, not tweaking the issuance curve. And Casper says, got to start somewhere and produce research and make proposals. Electra is about 1 year out, which is interesting coming from, a core Ethereum team member kind of person, a researcher, not a dev, but still, Electra is still about 1 year out. So there's plenty of time to discuss and do more research. It's not decision time now. I'm just excited and happy that we're finally talking about this clearly fundamental topic. So there was a whole lot of back and forth. And, here Nixo shared this tweet as well saying, this person's Francesco saying, I find it surprising that people seem to be okay with future where ETH is replaced by LSTs, possibly custodial. What good is decentralization of staking if there's no trustless asset? In my humble opinion, the staking economics debate should focus on this point first. He goes on to say, is there a way to prevent it other than reducing issuance, which does not mean targeting a negative issuance? He says, if so, I would love to hear it. If not, I'd love to hear why I should be okay with it. There are many aspects to this topic, but we certainly can't ignore this one. And Anthony Sano says, I don't think people are okay with this. They seem to think that the current proposal to fix this is not sufficient and actually does the opposite of what it claims, as in it causes more centralization of stake to happen into LSTs, just a smaller percentage of the overall ETH supply. So that discussion then carried on as well. So this, like I said, is quite a is getting people quite passionate. One of the comments that I saw in Discord was, in the Rocket Pool Discord, was someone was saying, Rocket Pool is finally getting to a point where, we'll be able to scale up to 22% of stake. But just as that's happening, with Petra being launched and the new tokenomics that will come in with that, at the same time, then Ethereum researchers will nerf Rocket Pool and all staking services, so much so that, it would act potentially as a limit on growth. Now, I'll give my opinion is that, I'm of course not a researcher, so I don't understand all the intricacies of the points being made here by Casper and others, but I think that this isn't going to go into Petra. It might go into the update after Petra. I think that's Osaka, because I think that, just look at something like EIP 1559, right? That was a change to the monetary policy. It was burning ETH. It was setting a fee market the way that it did, the gas market. And what ended up happening was it took 2 years of research and implementation before we got it on chain. This change will actually be bigger, I think, one of the biggest changes that will happen to Ethereum. And I don't think people are going to be happy with it happening in the way that it is. If the discussion starts, that's fine. I don't think this is going to make it into Petra. I think we'll see what happens after that. Okay, then Michael here kind of had a counterpoint. He's saying, would you support the addition of a rare duty on the beacon chain with a large negative payout around 2 to 4 ETH? It would function economically as the opposite of block proposal, penalizing pools most often and solo stakers rarely. And people are like, no. So people are like kind of trying to think of other ways that, you can like target centralized forces. The idea here, of course, being like someone like Lido with 33% of the share would get 33% of these blocks, which would impact their income, whereas solo stakers would get these blocks so rarely because they are so small, such a small percentage. The problem is if Bob down the street is staking and he's got 32 ETH and you hit him with a 4 ETH penalty, like Bob's going to get hurt quite a lot. So the impact this would have would be setting up some kind of, smoothing pool type situation. So that would have its own centralizing issues. But people are trying to think about this now, and it's going to be really interesting to see how that develops. Okay, next we had some like groundbreaking news coming out of Uniswap today. So Uniswap, there was a new governance proposal in a governance proposal in the Uniswap DAO, saying the proposal has the lead of the proposal EEC637 just posted a proposal to upgrade the Uniswap protocol's governance system. Specifically, this upgrade will reward Uni holders and who have staked and delegated their tokens. So what they're saying here is that if you stake and delegate your Uni tokens, you will be eligible to a share of the fees made by the Uniswap protocol. Basically, this is the fabled fee switch argument that, people have been making for a while, that pointless governance tokens aren't getting any income from the protocols that they are the governance tokens of. And this is something that, that there should happen. Of course, that kind of brings up the argument is, are they securities? Are they not securities? These vehicles of revenue sharing, like what's the legal aspects of this? But anyway, people here said that this is like the biggest week in Uniswap governance ever, and this is Erin Coin who posted the thing saying, I just proposed a large scale update to the system, and basically the markets absolutely loved this. So I don't know if you can see my screen, but basically Uni for the last, I want to say many weeks, many months, has kind of been trading in this $3 to kind of $8 range, somewhere around there, basically kind of somewhere in the middle, around $5 pretty much for the last, I want to say 2 years. Yeah, 2 years pretty much. And then today it kind of smashed that range and totally broke out of it with a giant candle that went all the way from, I want to say like $7 all the way up to $12. So at one point, it was up nearly 100%. And on the day so far, like right now, it's up 50%. So the point that I want to make about this is the RPL token, of course, is, let's have a look over here, right? So people in the community were talking about it, and L30 here was saying, what's a fee switch? And basically the idea is that, token holders get protocol revenue. I said it's sharing profits with token holders. And L30 says, so if RPL had a fee switch, our RETH commission would go to whoever holds RPL. And then basically the argument being is that this is what will happen with I said if Uniswap here sets off a wave of turning on the fee switch, you'd be crazy not to buy the governance tokens and sell them into a pump. And then the idea was that with Rocket Pool, with the new tokenomics, like we were just talking, there'll be a separate vault potentially just for putting in your RPL and getting ETH rewards, which of course is the definition of a fee switch, right? So because you're not staking, you're not doing anything, you're just depositing your ETH and you're getting a share of the rewards that are coming. Sorry, you're depositing your RPL and you're getting a share of the rewards that are coming in. So I said, you stake RPL, you get ETH rewards from ETH only node operators, which is what we spent the first chunk of the episode talking about today. And then basically people were just like getting really excited about this. I said, the fee switch might become a legit meta narrative if this Uniswap thing works out, and like a whole bunch of DeFi protocols might be jumping on the bandwagon here to try to turn on the fee switch of their own if they're feeling brave that now Uniswap might lead the way. Of course, this is just a proposal, but with Rocket Pool, we already have a kind of fee switch, right? Like where the RPL token gives you access to higher ETH rewards, but it's just going to become even more explicit potentially become more explicit with the future token upgrades. So that is, I think, something that you might be seeing coming forward. And see, this is the kind of thing I mean, like L30 here, who's quite frequently in trading, right? He still doesn't know about the tokenomics upgrades. He says, wait, I can only stake RPL and earn ETH commissions? Question mark, question mark, question mark, question mark. And I said in the new tokenomics, that's one of the suggestions. So we're trying to get people more aware of what's going on here and trying to get them to learn about all the changes that are happening. So it's going to be a really exciting time for Rocket Pool. So yesterday in the episode, I covered Logris's analysis of where Rocket Pool stands, and the protocol and the RPL token. And I was mildly critical of his post and kind of like, but I think I was too polite in my responses. Well, Val here didn't hold back. So he kind of quote tweeted subtweeted whatever the equivalent of is in Discord, Logris's Reddit post, and he said, Rocket Pool has failed to engage with the surrounding ecosystem as much as peers that came later than them, and now have more market share. And Val says there's only one protocol with a higher share, and calling Lido fully permissioned a peer is just off base. Then Logris said, despite me writing about how transformative EigenLayer would be for literally years. So he was saying that, Rocket Pool should have been working on this a lot sooner. And then Val says, the dude talks about it like it's already happened. It hasn't. It might or it might not be a big market, or a different competitor might take the market. Regardless, it's a huge risk to tie in hard before it's proven, let alone before it's deployed. Logris says, paid far too much for their ODA members who should have been contractually obliged to invest that in Rocket Pool. And then Val says that's a ODA complaint which we've already addressed and is being addressed actively. And then Logris said forcing every node operator to have to figure out every AVS basically means you can expect the average Rocket Pool node operator to have subpar yield compared to the more centralized ones. And then Val says this is doubly confused. First, Rocket Pool node operators are not currently eligible at all. Second, AVSs get paid for being run. Of course, a node operator needs to be able to run it if they want the yield. The only out is centralizing the operation, like having some central party pretend to be the various node operators and sign on their behalf. I don't think this is the not being a purist levels of centralization here. If we want protocol level, give someone that much might just be Lido. It's more efficient. There's some valid bits in there too, like ignoring memes, like we should market more. We do act as purists sometimes. Some version of that is written into the charters of the PDAO. It says, I believe this is sometimes limiting, but also huge brand strength. And then that Rocket Pool is generally slow. Val agrees that this is the most valid point. We have been too slow a lot of the times. And he says we're too slow with liquidity incentives. And he says maybe that's true, but Curve probably wasn't the right choice. And we probably did overpay the ODAO for a long time. So, Val did agree with some of the points that Greece was making, but also like very strongly dismissive of other points that were brought up there. So I thought that was a nice post by Val. Okay, next we have the new DeFi guide, that Regex Buster is making now with Stake with Rocket Pool. And here we get that there's some really nice rewards coming through, and we've got information here about what you can get and where you can get it. So, for example, there's rewards going all the way up to hundreds of ARB a day that you can get on Uniswap on Arbitrum, and some of the rewards of that are pretty nice. So if you are interested in that's 13.4% that you can get there, and also there's some on base where you can get on balance up to 21% now, and that's what I was talking about the other day. And there's a whole bunch of other rewards. So if you want to kind of dig down deeper into that, then definitely check out this tweet from Stake Rocket Pool and find out what's going on there, because you can use your RETH in some really cool ways. Okay, here we got news of Fizz putting a little POAP in the pings channel. This is thanks to Needler OP from Reddit. So I should have had this open actually beforehand. But let's go have a look at the POAP. This is a free POAP that you can collect, and this is as a way of celebrating that our ETH Finance welcomes Ether's return to 3,000, and it's like a welcome home back to 3,000. So there's a POAP for that. This is holders of this distinguished token were celebrating on our ETH Finance around the time of Ether's return to a value of $3,000 after nearly 2-year hiatus on Tuesday, February 20th, between around 1:45 GMT. So this was a nice little POAP that Fizz sent out, and 356 people have collected this POAP. And like I said, it was a free POAP to collect, so that was a really nice one from Fizz. Okay, next we have a client update. This client update today is from Prism, and they have the official release for support for Deneb and Cancun. Dencun, the consensus side is called Deneb. So they're saying that this, of course, is a mandatory upgrade, and all users must upgrade to this version 5 before the March 13th, which is when the hard fork happens. And we are going to end today's episode with this whole market getting kind of out of hand. So Maverick shared this tweet in trading from Board Genius, and he says, WTF, you can now restake your restaked ETH This is not a drill. So there's this new protocol called Zirkit, I think that's how you pronounce it. And what they are doing is they are letting you restake your restake tokens, and basically they are adding layer upon layer upon layer of risk here. And the consequence of this will be that as you add more and more layers of risk, you just need a very small problem on one of the higher levels, and you can have a liquidation cascade all the way down. So this is really adding risk that should not be there, but sadly it looks like people don't care and they're pushing that out. So yeah, it's going to be a fun year for Ethereum for all these different ways. But hey, like Rocket Pool is on the vanguard and we're doing some really cool stuff. So let's just keep doing that. And I think everything's going to be good. But anyway, on that note, thank you all for watching, listening, and being part of the Rocket Fuel community. I hope you all have lovely weekends, and I will see you on Monday. Bye.